Welcome to the deep dive. So, for months now, market benchmarks like the Nifty, they've kind of been consolidating, right?
Yeah.
Just moving sideways.
Yeah, stuck in a bit of a range.
Exactly. And that can leave a lot of investors, especially high net worth individuals, wondering, well, what now? How do you strategically position your portfolio for the second half of 2025?
It's the key question right now.
It really is. So today we're going to try and cut through some of that noise. We're diving deep into a really insightful interview with Ragav Ayangar of 361 Asset, which was published in the Economic Times.
A very timely piece.
Absolutely. And our mission here is simple. Pull out the crucial insights, the tactical adjustments, and turn what could be, let's face it, a dense financial chat into something genuinely actionable for you. Okay, let's unpack this.
Let's do it.
So Ragav kicks things off with his general market sentiment. Given the Nifty's been, well, stuck, like we said, what's his underlying macro view? What's really shaping things?
Well, his view is described as cautiously constructive.
Okay, cautiously constructive. What does that mean in practice?
It means fundamentally India's own story, strong domestic demand, policy continuity, the whole CapEx revival thing, that's all still very much intact. That's the constructive part. The engine's good.
Right.
But the caution comes from the global scene. Things like where U.S. interest rates heading, what's happening with China's recovery, which seems a bit uneven, and, of course, those background geopolitical tensions.
Okay, so global headwinds are keeping things in check.
Exactly. They're keeping the markets maybe range-bound for a bit longer. But, and this is important, he sees this pause not as a negative, but maybe as an opportunity, a chance to selectively accumulate quality companies.
So a consolidation phase before the next potential move up.
Precisely. Markets often do that. They pause, take a breath before the next leg. This could well be that moment.
That's a helpful way to frame it. And that perspective, it kind of leads directly into one of the interview's most direct recommendations, wouldn't you say? He suggests investors should, and I'm quoting here, cut exposure to crowded mid-cap trades and buy more large caps. That sounds pretty specific.
It is specific, and it's really important to get the nuance here. He's not saying, run for the hills and pile into gold.
Okay.
He explicitly calls it a tactical tweak.
A tweak, got it.
Yeah. The thinking is, look, some mid-cap areas have become maybe a bit overheated, too popular crowded trades, as he puts it. Valuations might be stretched.
Right, too much enthusiasm, perhaps.
Could be. So the idea is to trim that overexposure there and, at the same time, increase allocation to high-quality large caps.
So bigger, perhaps more stable companies.
Generally, yes. Companies that might offer better relative value or just more resilience in this kind of environment. It fits into what he calls a balanced barbell strategy.
Okay, a barbell. Explain that a bit.
Think of it like weights on either end of a bar. On one end, you have your core equity holdings, like these large caps. On the other end, you have defensive assets, maybe short duration debt, or, as we'll probably get into, things like REITs. Balancing growth potential with stability.
That makes sense. That balanced barbell idea, it brings us nicely to, well, a really crucial point for many HNIs and HNIs finding stable income, right? Especially with rates where they are.
Absolutely. The search for yield is ongoing.
So are things like real estate investment trusts, REITs, and infrastructure investment trusts, InvIT, are they genuinely gaining traction as a solution here?
Oh, definitely. They're picking up significant interest. You see, HNIs and UHNIs are actively looking for predictable cash flows.
And these offer that.
Precisely. REITs let you invest in portfolios of, say, office buildings or malls, and InvITs do the same for infrastructure like toll roads or power lines. You get income without buying the whole asset.
Right.
And their yields are often relatively attractive compared to traditional fixed income. What's fascinating, I think, is how they're now seen less as niche products and more as core components of a diversified income-oriented portfolio.
So becoming more mainstream.
Yes, exactly. They've matured, there's more transparency, and crucially, the tax clarity and stable regulations around them have really boosted investor comfort. Makes a big difference.
Okay, that clarity is key. So moving beyond these publicly listed trusts, what about the private side? Are family offices showing interest in things like private credit or structured debt?
Oh, absolutely. The appetite there is described as significant and definitely growing among Indian family offices.
Why is that? What's the appeal?
Well, private credit, for example, often offers a really appealing risk-adjusted return profile.
Meaning good returns for the risk involved?
Exactly. Especially now, as traditional bond yields might be plateauing a bit. Family offices, who are often quite sophisticated, they really value the predictable cash flows, the ability to get bespoke structures tailored to them, and of course the focus on capital preservation.
And what's driving this demand? Is it just the returns?
It's partly returns, but also driven by things like tighter bank lending norms. Banks being more cautious creates opportunities for private lenders. This can lead to higher spreads, better potential profit margins, and there's also a clear desire to diversify away from public markets.
Right, spreading the risk.
Precisely. And structured debt also plays a role here, sometimes seen as a strategic hedge against public market volatility. So it offers another layer of potential protection in choppy markets.
That's a compelling mixed diversification, potentially decent returns, managing risk.
Okay, let's shift gears slightly. What about more traditional assets making a comeback? Commodities, specifically gold and silver, are they just hedges again? Well, the source is quite clear on this. They're re-emerging, yes, but not just as hedges, but as tactical plays.
Tactical plays. Interesting. Why now?
It's happening against this backdrop of ongoing global macro uncertainty, which we talked about, but also, and this is noteworthy, continued central bank accumulation of bullion.
Ah, when central banks are buying gold.
It sends a pretty strong signal, doesn't it? So investors are looking at it more strategically. They're adding exposure through various means, straightforward ETFs, sovereign gold bonds, which offer a government-backed way, or even more complex commodity-linked structures.
So definitely more than just a safety blanket. It's an active allocation choice.
Yes, that's the sense you get. It's part of the strategy, not just a reaction to fear.
Okay. And staying with assets that aren't plain vanilla stocks and bonds, what about alternatives? Things like AIFs, alternative investment funds, and unlisted equity. Still alternative or more central now.
Raghav's view, based on the interview, is that they are no longer peripheral. They are becoming core to many sophisticated portfolios.
Really? So moving into the mainstream for these investors.
Seems so. AIFs, particularly Category 2 and 3. These cover things like private equity, venture capital, structured credit. They're attracting strong interest because of their ability to capture alpha in niche strategies.
Alpha meaning beating the market, essentially.
Right. Finding returns that aren't just tied to the overall market movement. These strategies can range from getting into companies before they go public pre-IPO deals all the way to complex credit situations.
And unlisted equity. Investing in private companies.
Yes. Significant interest there, too. Investors want to participate directly in India's private market growth story, but, and this is a really critical point they stress, selectivity, manager quality, and governance remain paramount. You can't just dive in blindly, especially in less liquid markets like these.
So due diligence is absolutely crucial. Makes sense.
Hugely important.
All right, let's broaden the view now globally. Is the advice still just buy U.S. tech, or are clients looking elsewhere for diversification?
U.S. tech definitely remains a cornerstone for many. It's hard to ignore its growth engine. But the conversation is getting more nuanced.
How so?
Well, that sort of buy-everything tech trade seems to be evolving. There's now noticeable growing interest in places like Japan, select parts of Europe, and Southeast Asia.
And why there? Different opportunities.
It seems to be driven less by chasing heat and more by seeking valuation comfort, finding places that maybe aren't as expensive, and also for sectoral diversification, not having all your eggs in one tech basket, so to speak.
Right, spreading bets geographically and by industry.
Exactly. So if you connect this to the bigger picture, the recommendation is for global diversification, yes, but not just geographically, also across asset classes globally. Think global credit, maybe thematic ETFs focused on specific worldwide trends, even global REITs.
Ah, so it's about hedging that risk of being too concentrated just domestically.
Precisely, building a more resilient, truly global portfolio.
That's very clear. Now, even with all this access to advice, ultra-wealthy investors aren't immune to making mistakes, right?
Nobody is.
So this raises an important question. What kind of common blind spots or pitfalls did Ragav Ayangar point out in the interview?
Yeah, he highlighted a few really critical ones. The first is overconcentration.
Okay. Too much in one thing.
Exactly. Too much in a single asset class or one particular theme or even just one country or region. And often, this is driven by recent past performance, chasing whatever did well last year.
The classic rearview mirror investing.
You could call it that. Second, there's the chase for yield without fully understanding the embedded risks, especially with complex things like structured products or private credit. You have to look under the hood, not just at the headline return.
God, don't just grab for yield blindly. What else?
And the third one is interesting. A tendency to delay decision-making in volatile times.
So freezing up when things get choppy.
Kind of. That fear of making the wrong move can sometimes mean you make no move at all, and that often leads to missed opportunities, paradoxically.
Those pitfalls sound potentially familiar to many of us, not just the super rich.
They're very human tendencies, I think.
Absolutely. So, okay, given all this, the tactical shifts, the diversification options, avoiding these traps, what's the kind of overarching advice from Ragav Ayangar to navigate the rest of 2025? What's the bottom line?
Look, the core advice comes down to this. Stay diversified, focus on long-term compounding, and avoid binary investment calls.
Binary calls meaning like all or nothing bets.
Yeah, don't try to perfectly time the market or bet the farm on one specific outcome. It rarely works consistently. And the real wisdom, the profound insight running through it all, is this idea of strategic patience.
Strategic patience. I like that.
It's about having a solid plan and the discipline to stick with it, rather than reacting to every headline or chasing every trend. In the long run, he suggests that strategic patience often outperforms trying to be tactically brilliant all the time.
That's powerful. Strategic patience beats tactical brilliance. What a fantastic deep dive this has been.
Agree.
We've really covered a lot of ground, that tactical shift to large caps, the appeal of REITs, InvITs, private credit, commodities coming back strategically, alternatives becoming core, global diversification beyond just the U.S., and crucially, how to avoid those common errors. It feels like a solid roadmap.
It is. It's a really good snapshot of how sophisticated investors are trying to position themselves for, well, whatever comes next.
Indeed. And for you, our listener, maybe here's something to think about building on that last point. How can you apply that principle of strategic patience, not just in your investments, but maybe in other complex areas of your life? Places where, information overload or short-term pressures can sometimes push us into hasty decisions, something to mull over.